like we've been telling you, it's been a lot about the earnings, and Tata Motors also posted a very strong set of first quarter numbers. And this time the performance was really driven by what we saw come through from Jaguar Land Rover, right? So we saw the margin expand and the revenue went up around 57%. So very solid show there. In fact, Tata Motors board has also now proposed to convert its DVR shares to ordinary shares and will issue 7 ordinary shares for every 10 DVR shares held by shareholders. Sonal is here to tell us more about what the tax implications of this move could really look like on shareholders of DVR. Sonal.
Thank you so much for that. Well, as you pointed out, Tata Motors has approved a scheme of arrangements for a capital reduction of the A ordinary shares of Tata Motors DVR, and such shareholders will be receiving Tata Motors shares as a consideration. Now, since there is a transaction which is involving cancellation of equity shares, it would mean there would be some tax implications as well. In usual scenario where there is just cancellation of shares, there will be 2 components in terms of taxation. One would be deemed dividend, which will be attributable to the accumulated profits that the company has, and the second will be the capital gains, which will be attributable to the capital. Now, dividend income will be considered only to the extent the amount of reserves that are present in Tata Motors DVR's books of accounts. However, in this case, there is no cash outgo, or so far we know that there is a consideration in terms of Tata Motors shares being given to Tata Motors DVR shareholders. In that case, what does it look like? Now, in that case, there still will be a capital gains tax here, because there is a change in the capital asset that the shareholder is receiving. Capital gains tax will be levied in this case, and if there is a cash outgo by the company, there will be a deemed dividend. Fair market value will be the value of new shares for calculation of capital gains. Just simple example that we have tried to explain it with. Some of them are assumptions because it is going to be a very complicated structure. Assuming that the fair market value of Tata Motors share is the current market price and multiplying it by the number of shares that Tata Motors will give to Tata Motors DVR shareholders, that is 7 shares for every 10 held, the total consideration would be 4,550 rupees per share. We are not assuming any cash consideration here, but we do not know whether that will go ahead and happen as well. In case there is a cash consideration, considering the deemed dividend as per the reserves at around 25 rupees, the sales proceeds of the reduced share after that will be around 4,525 rupees per share. If it is a long-term capital gain, there will be an index cost of acquisition. So calculating that around 3,000 rupees. So the capital gains here will be 1,525 rupees per share. A lot of these numbers are based on assumptions because we do not know the shareholding of every shareholder in a particular way. Now, what the tax implications would be for resident shareholders? There would be a tax on the deemed dividend of the 25 rupees that I spoke about. TDS of 10% by the company will be levied on the dividend payout if the dividend payout is more than 5,000 rupees a share to the shareholder. It is now taxed in the hands of the shareholder. And capital gains tax will be according to the period that you've held it for, the amount of acquisition, and the amount or the price of Tata Motors share on the day of that particular transaction happening, when it is actually approved by the NCLT. And if it is for the NRIs, they will be receiving the dividend, but it will be taxed at 20% as per the tax deducted source norms that we have as per the income tax rules. So yes, 2 sets of taxes that they'll have to pay, one on the deemed dividend and second on the capital gains tax.
Sonal, that's extremely helpful. Thank you for breaking that down completely and taking us through what the implications of this kind of exercise could really look like on the shareholders. But with that, let's also